Before you buy your next investment property or first investment property, just hold on a second, because so many investors blow thousands of dollars by making just 3 avoidable mistakes. Let's make sure you're not one of them. Hi, I'm Eric Lee. I'm an accountant and licensed real estate agent, and your guide to the tax-smart property investment. In this video, I will unpack the top 3 mistakes that could potentially ruin your portfolio. They are misunderstanding of tax system, skipping due diligence, and mismanaging cash flow. If you're still interested if you want to find out more in details, please stick around to the end. Let's dive straight in. First up, it's tax. It's not sexy, but it's the silent partner in every single deal. I've seen so many investors, including buyer agents, talking about tax matters around property investment online. And it seems that they know it all, but it's not actually the case. Some tax implications could ruin your property investment if you don't know or use irresponsible advice from unreliable sources. There could be hundreds of matters, but let me bring 3 main ones to you today. The first mistake is not to choose the property structure correctly up front. This is a kind of overlaps with the legal matters, but actually this is one of the things I discuss with my clients every single day. As you may already know, you can buy properties in individual name, or company names, or trust. I cannot explain everything about each structure today, but I can promise you that I will post another video next week about deep dive into each structure, like how it works, pros and cons, etc. In short, ownership structure means 2 main things: asset protection and tax savings. Because you cannot change the structure later unless you're willing to pay stamp duty again, this is something you must think about and do it right up front. And second thing is about main residence exemption. You may already know that CGT is exempt for your home that you lived in as a main residence. But many people actually misunderstand that your home is exempt for CGT regardless of how long you actually lived in there. Main resident exemption is only available for the period you actually lived in there. So if you lived in your home and later rented out, or you moved into the investment property so it became your main residence, only the period you lived in is exempt for CGT. So partial exemption may need to be calculated in this case. One exception is the rule often referred as a 6-year rule that allows you to still claim CGT exemptions in full if you didn't buy another home and you sell your previous home within 6 years after you moved out. The last tax mistake is about depreciation. There are 2 different types of depreciation. One is for the plant and equipment, and the other is for building. They are both expenses that you can claim, but depreciation on building must be added back to the cost base when you sell the property. This means the part of the depreciation is actually temporary, but don't ignore the fact that you get 50% CGT discount if you held the property for more than 12 months. But depreciation expense is 100% deductible, so you're still better off by claiming depreciation buildings. It's not just temporary, but half of it. The second mistake is buying on vibes instead of verified data. Your brother-in-law's hot tips or glossy brochure and sunset walkthrough do not equal research. Some of the examples what you want to look out for is vacancy rate under 2%, days on market trending down, population growth beating the national average, median rent growth about 4% per annum, and 1 to 2% extra for the regional areas, and infrastructure pipelines with funded projects, environmental overlays such as flood, fire, heritage, bushfire zones, etc. Mistake number 3, too much focus on equity while ignoring cash flow. Property investment, especially residential property investments, are long-term wealth building journey, and certainly not get-rich-quick scheme. Although building equity is the most important aspect of property investment, without cash flow, you cannot achieve your goals. So the equity is the goal and the cash flow is the path to the goal. Therefore, you should focus on both aspects, not one. I've seen so many cases that people had to sell properties before they actually accrue the desired amount of equity because of the cash flow pressure, especially when the interest rates were going up. Let's imagine that someone actually bought a property in Perth in 2017, then held it for 3 years, but could not hold on to it because of the cash flow issues. That 3 years would have been totally wasted because substantial growth actually started since 2022, which he could have doubled the investment if he could hold on to it 3 to 4 more years. So do not get stuck on equity too much and buy a haunted house in a big block thinking that the value is on the land, not building. Because if you can't afford to hold on to the property with the level of income you can get from the property, the potential growth is not yours and it could waste your time and money for someone else. In summary, in order to avoid all these mistakes I just mentioned, you want to do these 3 things. Choose the right structure up front and do your homework and make informed decisions backed by data. And balance equity and cash flow because you need them both. If you found today's video useful, please hit the subscribe button and stay tuned for future updates. Thank you for watching and I will see you in the next video. Bye for now.